Welcome to the Osborne Financial Group podcast, hosted by Jared Osborne. Join us for expert insights on wealth management strategies, essential tips for securing your financial future, and in-depth discussions on life and health insurance options. Get practical advice for protecting your assets and loved ones, proven strategies for maximizing investments, and real-life examples to illustrate key concepts. Stay tuned for Q&A sessions with industry professionals and actionable steps to take control of your finances and insurance needs. Tune in now and empower your financial journey.
Well, hello there, everyone. We are back. And Jared, I think most people have a pretty basic understanding of your typical garden run-of-the-mill term life insurance, right? Everybody's seen an ad for it. Pay as little as $1 a day or $9 a month and protect your family, that kind of thing. So you pay premiums every month for a certain term. And then if you pass away during that term, it pays out on the policy. So pretty basic. But there's another side to this coin that I think most people don't fully understand, which is the topic of our discussion today, and that's permanent insurance. So let's start there, Jared. What is permanent life insurance, and how does it differ from your typical standard term life insurance policies?
So good morning.
Morning.
So term insurance, like you just mentioned, is exactly what you said. You have it's a renting insurance. You have it for a specific term. Typically, they're level, not all of them, but typically level premiums. 10.
What do you
20,
say? Hold
30.
on. Sorry to cut you off. When you say level, what do you mean by that exactly?
They stay the same.
Okay, stay same.
Okay. They're the same every.
Okay.
However you pay them monthly. You could pay them monthly, quarterly, annually, semi-annually, and typically, unless you have what's called a graded policy, but those aren't. Those are, not great policies where it goes up every year or two. You want to have a level term. That's the way most of them work. And you, like you said, it's 10, 20, 30-year term, could be 15. It's various terms you can have. Obviously, the shorter the term, the lower the cost. But yes, the level term. And if you die within that term, you get the death benefit. If you die after the term, there's no death benefit. So the main difference between permanent and term is permanent, as long as you pay the cost of insurance, as long as you pay the premium, you will have that death benefit forever, or at least for a certain some permanent insurance, pay till age 100, 120, most pay till age 120, but basically your life. Most people, are not going to live to 100, but most policies end at age 120. So that's the major difference. There are a lot of other differences. We'll get into that, but that's the major difference. So term, you're renting insurance, you have it for a specific term. Permanent insurance, like the name, is permanent, so you have it for the entirety of your life, as long as you pay the premiums.
I mean, it seems pretty straightforward, but it is a little counterintuitive. Why do you think that it's so often misunderstood by people, and what should people generally know about its unique benefits?
Okay. Most agents won't say this, but I'm not a big proponent of buying permanent insurance just for death benefit, unless there's specific situations. For example, one, you can afford it. So term insurance, and the reason why it's most popular, and the reason why it should be the most popular, is it's the cheapest form of insurance. And I believe that most people, if you're just getting, hey, I need to protect my family, or I need to protect whatever, a key person in my business, or whatever, you get term insurance. Okay. It's the cheapest. It's the most economical. It does what it's supposed to do. Most people at age 20, 30 typically need insurance for 20, 30 years. And after that, their kids are off, or, they're established, they're fine, they can retire. They don't typically need the insurance. You can always extend it and buy more down the road, and take a look at your term insurance in 10 years. If you have a 30 insurance, say, hey, I need more. Very common. You're adding to your insurances throughout your life and career. Just like disability insurance. And we talked about that during another podcast. Yeah. But, okay, I'm not a big proponent unless you need it for estate planning purposes. Okay. For permanent insurance, just for the death benefit, unless it's very specific, because it's very expensive. Okay. Now, most permanent policies have a savings component to it. Okay. And most permanent policies are considered tax shelters if structured correctly. But the reason why there's a big misconception or negativity to permanent insurance is that it's typically sold. I don't sell insurance, but I mean, I do, but that's not the good. It's typically offered or shown to the wrong people. And what do I mean by that? I think the number is anywhere between 70 and 80% of permanent policies eventually lapse. That's a huge number. That's a problem.
Because people don't pay the premiums, right?
Because they don't pay the premium. Yeah. Because it's not, and I hate to get into the economics of the every individual, but really, if you're making 60, 70, 80, 90, you shouldn't be buying these policies. They are for very specific situations and people. Okay. They're asset protected vehicles. I do a lot of it for doctors and lawyers because they are typically industries or that could get sued, especially doctors. A lot of family members are doctors. My family, if you buy a life insurance policy, you can't be attacked by creditors. Okay. So that's a big reason why a lot of doctors buy life insurance for the savings component to it. Now, like I just said, they're typically sold to the wrong people. Okay. Premiums are typically 5, 6, 7, 800 plus a month. Term could be 50, 60, 70, 80, $90. It's inexpensive as long as you're healthy. And so that's the big misconception or the negativity to permanent insurance is that they're sold to the wrong people. And a good majority of these policies they lapse for non-payment of premium because in year 7, 8, 9, 10, they need a new roof on their house. And what do they get rid of first? The life insurance policy. It's
But you can also borrow against the policy if you need funds, right?
Correct.
And then
Correct.
So
that's how I typically will show them to very specific clients. So if I have a client, okay, where I'm doing a lot of things for them, like they have investments, they have stocks, they have bonds, they have annuity, managed money, whatever they have, okay, this for certain clients should be, in my opinion, a piece of the pie, very small piece, maybe 5%, maybe 10, maybe the most. But if you're a person that has, $2-3 million of investable assets, I believe that you should have a little bit in permanent insurance. Now, unlike term insurance, where you're saying I need $1 million of death benefit or $2 million death benefit, I truly believe that with a permanent policy, you should back end into it. And what I mean by that is you should get as little amount of death benefit as possible for the amount of premium you're putting in. Okay. And the reason for that is you want to keep your cost of insurance low. So we talked about, you just mentioned you can borrow against the policy. So you have that growth in the underlying permanent policy to build cash value. And there's different types of permanent policies. I'll get a little bit into that on how they grow. Okay. You hear about whole life, index universal life, those type of policies. So you're basically overfunding the policy. Okay. So you're getting as little amount of death benefit as possible for the amount of premium you're putting in. So I typically start a conversation, say, hey, look, you have all these things. Let's talk about life insurance for a second. Let's talk about how if you borrow against it, it's a tax-free, you can borrow money tax-free because loans are considered tax-free investments. You build cash value based on, depending on the type of policy. If it's the whole life, it's an interest rate and you get dividends from the underlying, or typically you get dividends from the underlying insurance company, or an index universal life where you're putting it into a specific index. You have a cap or a ceiling, typically 7, 8, 9, 10%. Conversely, if that index goes down, S&P, NASDAQ, things like that, you get zero. So you're going to do zero or whatever that cap is. So you have whole life, you have index, and then you have what's called variable universal life, which has no bottom, where we talk about index universal life, where you can, if the market goes down, you get zero. What is a VUL or a variable universal life? There is no bottom. If the market goes down, you're going down. Or if the mutual funds or the investments you're in on the underlying policy goes down, you're going. Conversely, there's no cap or upside, cap.
Okay,
or
so more
limit.
risky, more potential
More
upside,
risky, more volatile.
Have to be, index is more stable.
Yes.
So is question
Yep.
for you. You mentioned whole life, then indexed, indexed
Universal life. Yep.
and then variable. So variable is the most. I'm guessing variable is the most risky of those. Then the indexed one is kind of in the middle, and then whole is your standard. Or is
100%.
No? Yeah,
Whole
okay,
life
gotcha.
is like, it's like, hey, you're getting 5% or 4% or whatever it is, and then then the underlying insurance company typically will throw off a dividend, depending on the company. And
Interesting.
you're not, and people have these, unless it's a VUL where you're not gonna knock the cover off the ball in terms of returns. Maybe you'll do 5 to 8%, but okay, especially on the the whole life or the index universal life. That's what they've done. There's arguments and there's books written on comparing a permanent life insurance policy to a 401k. And when you take the money out, okay, taxable equivalent returns, okay, and you're in a high tax bracket and you have a 401k and it's not a Roth 401k. Let's just say your 401k and you've done 10%, you've done really well, 10% over your life of the 401k. When you start pulling money out of a 401k and you're in a pretty high tax bracket, because most wealthy people are probably going to stay in a tax bracket, and who knows what taxes are going to be in 30 years, 20 years, because it doesn't look good. 30 million dollar $30 trillion deficit. I don't think we're going, hopefully tax will be lower, but let's just say they're the same or higher. And you're pulling out money out of 401k, and every time you pull that money out of the 401k, which you have to at some point because you roll it to an IRA or you're 70 and a half or whatever, 72, 70, depending on your age or when you were born, you have to pay taxes on that. And typically taxes are 20, 30, 40%. Now, depending on what tax bracket, your ordinary income bracket is when you pull money out. So your 100,000 that you put into a 401k, yes, you got the pre-tax benefit of putting that money in, a small benefit when you put that money in. That 100,000 will be 80 or 70,000 when you pull it out. A life insurance policy, conversely, yes, it's after tax dollars going into it, but when you pull $100,000 out correctly, where you do it as a loan against the policy, that 100,000 is 100,000. Okay, so there's arguments on both sides. I think you should have both. I'm not like one or the other, because who knows what that, but it is. And also, you have a doctor that, does very well. Okay. And has millions in real estate and stocks and has money, to invest and wants to protect his assets. This is a great way. I have doctors that throw a lot of money into these policies. It's safe. They don't need the money, anytime soon. But they build up a nice cash value. They'll average anywhere 5 to 8%. Really not a lot of risk, as long as they're paying the premium. They may do a little bit better than 5 to 8%. They may do a little bit more, but they're going to do 5 to 8%. It's what they've always done and what they will. And as long as and another thing is another negative, if they're not structured correctly when you buy these policies. And what I mean by that is it's just not like, okay, let's throw in $1,000 a month into this policy and see how it goes. You got to understand things like the death benefit. You want to have an increasing death benefit on some of these, which you can have on like a term policy. You can't really increase the death benefit unless you go through underwriting. With permanent policies, because you're putting money in every month or every year, you can actually have an increasing death benefit every year. And then because you want to have that increasing death benefit, even though it's going to cost you a little bit more, because when you take a loan against the policy, when you start pulling money out of these policies, how do you pay the money back? You pay the money back at death. Okay. You pay the money. So you have $1 million, $500,000, $1 million death benefit. At 65, you start drawing income off the cash value via a loan, tax-free loan. Okay. You've pulled out, you have $600,000 in cash value. You retire, you start pulling out $50,000 a year or whatever. You could do whatever you want. You could pull out $100,000 1 year or two, however you want. Let's just say you consistently want to pull out $50,000 a year. You die, your loan now is $400,000. Your loan balance is $400,000. Your $1 million death benefit, you die, okay? The death benefit pays back that $400,000. Your beneficiaries get $600,000. You pulled out tax-free $400,000. Your beneficiaries get $600,000 tax-free, because the life insurance death benefit is always tax-free. You pulled out almost $1 million of life, and this is the way they work. If you do it correctly, you pulled out $1 million. You $400,000 for you and $600,000 for your beneficiaries, tax-free. You probably put in a couple $100,000 into that policy. So think about that. Your total overall benefit between you and your beneficiaries on a tax-free benefit, you literally have taken out $1 million between the death benefit and the loan, and you've put in about 250, and you're done. So that's a great policy, and that's the way they work, Jared. That's the way they work.
I'm sorry to cut you off. It's no wonder why people are confused by this stuff, because there's so many variables and so many moving parts. And it's even all the more reason why it's so important for you as a financial planner advisor to really get in and understand the entire situation. I know we've talked about this before, of a person, their goals, what everything is, because this type of investment vehicle is a great tool, but it's not great in isolation. You have to do other things along with it. But I'm curious about the different types that you talked about. In terms of you selecting or recommending for a client, is that entire, like the whole versus the index versus the variable, would that entirely be based upon their personal risk tolerance? Or is there ever a scenario where you'd recommend a client maybe get a whole policy and then get an index policy? And it just depends on the actual person and their goals?
Okay, first, yes, the answer is, so whole life really hasn't been a big thing recently, because as I mentioned, whole life is based on prevailing interest rates. Because interest rates previously in the past couple of years have been very low, really hasn't done very. If you look at the numbers in terms of sales by insurance, wholesale has not been great, and the reason for that is because it's based on an interest rate, and interest rates have been so low. Now, over the past year, you've seen interest rates go up, so they've kind of, like CDs and bonds, have become a little bit more popular recently. IULs have become the most popular in terms of new sales. Okay. And the reason for that is, it's like you mentioned, it's a cross between the whole life and the variable universal life. It's somewhere in the middle in terms of risk. There's not a lot of risk if it's done correctly, because you can't lose on the policy as long as you pay the premium. There's no downside except for the cost of the policy, of the cost of insurance, administrative costs, which can get high. And that's another thing I want to mention. But going back to that, it does depend upon the client. I'm a big proponent of IULs. I think VULs, really have to be managed just like a portfolio, and most people get away from that. When they just think it's like, and they forget about it, and you can't really forget about it because it has to be managed. A whole life, they're steady Eddie, they're very safe, but they're not going to, IULs are going to do better over the long term, and they've proven to do better, just because with the whole life, maybe you'll get a 4 or 5% return. You get a distribution or dividend from the insurance company. Maybe you'll do 4 or 5% on it. Maybe 5.5%. On IUL, you can literally do 6, 7, 8% on that. If you're in it for a long period of time and the market does what it does, and you're in an index like the S&P or some sort of esoteric index that's done well. So yeah, it really does depend. I typically show IULs just because it's performance wise, it does better than whole life, and it's not as risky as a VUL, and there's not a lot of downside risk if it's done correctly. But you mentioned, you really have to, they're confusing. They're just like an annuity. You do need to make sure that you're with somebody that knows what they're doing, that's trusted, because if it's not designed correctly, and you're going, it could blow up on you. And if not told, like, hey, you're putting money into this policy, if you're not putting enough money into this policy, which is part of that whole, you better know what you're doing, and it underperforms, you can get a call from the insurance company or the agent and say, hey, look, you put money into this policy hasn't performed well, you owe money, or the policy is going to lapse. And that you got to be very careful with. So you got to know how to structure these policies. But if done correctly, they're excellent. Okay. Tax efficient, long-term investments. Okay. But got to be to the right person, and got to be structured correctly. And you better, go with somebody that knows what they're doing and you trust.
What about some real life examples? Do you have any personal anecdotal stories about clients that you've worked with that have had great success with these products?
Most of my clients who have them have a great say. Look, the one thing you got to be realistic with expectations with these policies. In the first, and this is where like people are like, oh, okay, like when you buy a home, okay, when you buy a home, in the first 3 to 6 years, you're underwater, okay. That's the way these policies work because, okay, first of all, most people who invest do it in increments. They say, okay, I want to put $1,000 a month or $500 a month. Okay, you're not going to see much growth in the first 3, 4, 5 years when you're putting, 5, 6, 7, 8, 9, 10. What do you? Let's just say you're doing 7%, 6% on 10,000. Okay, you're making $600. You know what I mean? But compounded every year over 5, 6, 7, 8 years, that number will grow. Okay, so the cash value once you start putting in, let's just say it's $1,000 a month, $12,000 a year for 5 years. You put in 60. Let's say you've averaged 6%, and you have at that point, 70,000 in there. I'm making it up. Then when you start doing 5, 6, 7, 8%, depending on what the index does, then your money starts really growing, right? Because 5, 6, 7, 8% on 60, 70,000 starts getting 5, 6, 7, $8,000. Then that money starts really compounding. But in the beginning years, first of all, they're taking out most of the administrative costs in the first 3 to 5 years. Like when you buy a home, most of the costs are in that first year or two. Okay. Secondly, it takes time for these things to build up, as opposed to typically when you buy an annuity, you put money into portfolio. You put that lump sum in and you add to it little by little. So you have, a good amount of money to grow in the beginning stages. Whereas a life insurance policy, it takes time for that money to build up. Okay. Minus the costs, which there are costs on permanent life insurance policies, heavy in the first 3 to 5 years. Then those costs start coming down. And then you're just pretty much paying, some administrative costs and cost of insurance. But I always tell my clients, look, in the first 3 to 5 years, you may be even down a little bit because they take their costs down. It takes time for this thing to really ramp up because you're putting money in incrementally. But this is a real 10 to 20 year investment. Most people, especially the younger generation, are not patient. They want instant gratification. This is a long-term investment, but if done correctly and you're consistent with it and sold to the right person who can afford to pay premiums for 10, 15, 20 years, it's not for everybody. Okay. Now, a lot of people can't. And that's why what I mentioned before, somebody who's making, not that it's bad at living, 70, 80, 90, 100,000, it's fine, but they shouldn't be putting $500 a month into a policy. It's 10% of their, or 6, 7, they shouldn't be putting 6 to 10% of their income into a policy. So
this,
yeah.
Sorry, I was going to say that the whole life insurance, permanent life insurance, sounds like it would be an incredibly powerful tool if you're in the position, like when you have children, if you have enough capital on hand, you can create a policy for them and start paying that off when they're young. I just think 30, 40 years down the road, they're going to have a nice pool in that policy, no?
I do it for my kids. It's a strategy. It's, it's a little bit, some people have positive things to say about that strategy. I'm a big proponent of it just because the cost of insurance is so low on a child. You hate to get an insurance policy on your child, but a lot of people are like, I don't want to do that. It's, bad luck. I'm getting death benefit on my kids. I get it. But from an investor standpoint, yeah. I mean, I have a policy on my son. I put in about $400 a month. Okay. He has 60, 70 grand. And I've been doing it since he was a kid, baby. Okay. And my idea is either I can pull the money out. I'm the owner, so I have control over it. He's the insured. I can pull it out for college, tax-free. I can pull it out for whatever, bar mitzvah or party, if I need it. Or ideally, which is what I want to do, is say, here, my son's name is Jesse. Here, Jesse, here's a life insurance policy for you. There's $100,000 in there that you can use for whatever the hell you want, or you have life insurance. You don't have to buy any more life insurance right now. Enjoy, you're married, start off your life. There you go. So that will be my ideally gift to him when he gets to a certain age.
Yeah, and you could set it up so that it's really, if you wanted to, like you could set it up so that it's released to him at when he turns 30 or whatever it is.
Or you just
like,
say, here,
add it to the trust fund.
I could change the owner. You're the owner now. It's your responsibility. Yeah. That's the strategy. But really, and another thing, Jeremy. So there's another reason for these permanent policies. I'm going to go into the ultra wealthy right now. So when you die, if you're very wealthy, I'm talking $20 million, you have an estate exemption. There's certain things that you have a tax exemption. It's around $14-15 million right now. Okay. So if you have a large estate, okay, you don't have to pay estate taxes on that first. I think it's 13 to 14 million around right now. That number fluctuates depending on who's in office. Typically, Republicans want to have that high exemption, not getting political, but it's the way it usually is. And Democrats usually want to lower it. Okay. Right now, it'll stay high. Okay. We got a Republican president. But if not, let's just say let's just say your exemption is 15 million, your estate's worth 50 million. Okay. A big strategy is what's called an ILIT, an life insurance trust, where you're putting the life insurance policy in an irrevocable trust to pay the estate taxes when you die. And it's a very important strategy for ultra wealthy people because they do not want to pay those estate taxes when they die. They want to leave it to their family typically, or whoever, charity or whatever. Typically charities, you're not going to have to pay tax on it, but they want to leave it to somebody, or they want to keep it a generational wealth. And what they do is they buy a permanent life insurance policy within an irrevocable trust, pay the trust actually pays the premium. And then you have your assets also put into this trust, typically, real estate, stocks, whatever. And when that person dies, the life insurance policy pays the estate taxes. So it's called an ILIT. Okay.
I like it.
You need an attorney typically for it to set up the irrevocable trust. That's usually when I come in. I deal with attorneys, or the client actually calls me, said, hey, I'm setting up an ILIT. What do you got? And then also another thing is these policies, not for estate planning purposes, because those policies can be bought for a little bit older people because they can afford it. Even if I'm talking premiums of 100,000, 6 figures plus. I mean, they're big estates. You can have permanent premiums $200,000, $300,000, $400,000. Your estate's worth $100 million. You pay it, okay, to pay those estate taxes, okay. But these policies, the way we structured it before, where you're getting as little amount of death benefit as possible for the premium you're putting in. There's an age range for these policies: 20 to 45, maybe 50 if you're very healthy, maybe, because once you hit 50. The cost of insurance gets too much, and it stunts the growth of the underlying the underlying cash value that you can potentially get. So if you have it's 20 to 45 is the sweet spot, and 45 is even maybe, depending on if they're very healthy or not. Most 45-year-olds have some sort of issue, and life insurance, it's stringent, especially with these policies. They're going to look at not your health, your motor vehicle, if you take any medications for, like everybody takes something for mental health these days, it affects the underwriting. So if you're not able to get a preferred rating or a standard plus, which is right under preferred, probably not a great investment for you, because then at that point, the cost of insurance becomes too much, and you're really not going to do, 6, 7, 8%. You're going to do much less, and you're better off just putting money into, an index fund and going from there. I mean, it just gets to a point where it's not for everybody. A certain age band, when you're doing it for an investment purpose, but for estate planning purposes, that's another reason for permanent insurance. And typically those are done. You're not building cash value at that point. That's not for the cash value. You're buying it for the death benefit. And there's something called a guaranteed universal life, which basically is a permanent term policy. You're basically buying a permanent policy that doesn't build much cash value, that you're just buying it forever. Okay. So, and there's, actuarially, they do the numbers, and that's what you buy typically in ILIT. You don't really need the cash value build up, because you're basically using that to pay state taxes when you die.
Jared, this episode has just cemented the fact in my mind that I need a professional to help me with this kind of stuff, because there are so many variables and so many moving parts, and it's so difficult to go at this alone. So all the more reason to reach out to somebody to help you with this kind of stuff.
Yep.
So let's leave it at that. I want to speak to anybody out there that's watching that has had experience with whole life, permanent life insurance. Drop some comments below. Let us know what your experience has been. If you have any of your own advice, anything that's worked for you, maybe hasn't worked, leave it in the comments. We're going to look through the comments, and if we find something that's rather interesting, we want to invite you to come on the podcast and talk about your experience and give some firsthand anecdotal stories about your foray into the wonderful world of permanent life insurance.
Great idea. And one last thing, Jeremy, before I leave, one last thing is not only should you be very aware of how you're, when you if you buy these policies, how they're structured, who you're dealing with, but if you, like you mentioned, if you have a current policy, you need to look at these things every so often. Not that the agent has to call you every year, then they should say hi. I mean, but they should be evaluated. Things change. The crediting, the amount of interest you get on these things, not on whole life, but on the IULs, the index universal life, they could change every year. The indexes could change. So, and even a VUL, 100%, you should be looking at these things every couple months, every 6 months, every year. Absolutely. But index universal life, whole life, you should look at these things. If you've had them for a while, there may be benefits of exchanging them to something better. Not always, okay? And that's typically a negative, but there are times when you need, or you can tweak the policy, lower the death benefit. You can't increase the death benefit unless you go through it, but you can lower the death benefit. You don't need as much death benefit. You can lower it and keep your cost of insurance even lower. So when you do put the premium in, you're getting more bang for your buck. Now I'll leave it at that.
Right. Makes sense. All right, everyone. Thanks so much for tuning in, and we will catch you all next time on the next episode of the Osborne Financial.
Thanks, everybody. Have a great week.
Take care. Have a great day.
Thanks for tuning in to the Osborne Financial Group podcast. For more financial tips and personal advice, visit us at www.osbornefinancial.com. That's www.osbornefinancial.com. Or give us a call at 954-963-3300. Take charge of your financial future today.